The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Felix Moreno, keeping you up to date with expert opinion on precious metals and the markets.
Hello and welcome to the Gold Money Podcast. This is Felix Moreno. I'm talking to Mike Shedlock, or Mish, blogger at Global Economic Analysis and registered financial advisor at Sitka Pacific. Hello, Mike.
Hi, it's a pleasure to be back on the show, Felix. People can find my blog by doing a Google search for Mish, M-I-S-H. It's just the first two characters of my first and last name. And I write about gold, interest rates, the global economy, China, everything that's in the news. I'm writing about it several times a day.
And you seem to manage to keep tabs on what's happening all over the world. It's pretty amazing.
I do. My big focus here lately has been Europe. So much is happening there.
A lot. I can attest that. But let's start off with the U.S. because we had the Bernanke congressional testimony yesterday, and he was asked some pretty funny stuff. Even at some point he was asked whether he was printing money, to which he answered, not literally. So what do you have to, what are your thoughts on what Bernanke said yesterday?
Well, of course he's printing money. He's even acknowledged that he's printed money. I've got a video clip of him telling, I think it was CBS News, he said, we're printing money. So he's contradicting himself when he says that he's not. But all of this talk about taper, you can tell what they're trying to do. Interest rates on 10-year treasuries went up over 100 basis points, 1 full percentage point, and he's trying to talk them down. Interesting, yesterday he came out and said, oh, well, the market's finally starting to understand what we mean here. Is it really? All we've seen is a little bit of a lull here in the interest rate spike. Have they controlled it? What's that going to do with houses? The mortgage rates are up even more than 100 basis points, and I think that's going to put a real crimp in housing. As for their exit strategy, Bernanke knows, we all know that the Fed doesn't have one, that they intend to hold these assets, to market all the way to the bitter end. There is no exit strategy. They don't plan on hiking interest rates. That's certainly very believable. He did say that. But you know what? What if the Fed's not in control, Felix? What if the Fed is not in control? And what if the bond market comes out there and says, we're just going to reprice these assets because interest rates are, too low? And what can the Fed do about that then? I don't think they can.
But just for a second, there's a thought experiment. Let's imagine that they did try to exit. Let's imagine that the Fed did stop buying, half the new bond issues and tried to actually get rid of some of the massive bond holdings they've accumulated recently. What would happen to the bond market?
Well, there's two issues there. What if they, just slow down or stop, and what if they go to sell? If they would actually go to sell, all the major brokerages would front run the trade. Interest rates would spike up like mad. If you take a look at we've got interest rates here at near record lows, yet the amount of interest on the national debt of the U.S. is near all-time highs. So you tell me how that works if interest rates spike. So clearly the Fed is not going to be hiking rates. And actually the same holds true for banks around the world. Japan is in a world of hurt if interest rates rise as much as, 2 percentage points. So all these banks intend on holding this stuff, these rates low. But that's their intent. The problem for these guys is, what if the bond market doesn't go along? We're seeing the beginning of a revolt here now with interest rates spiking up 1 percentage point. So is that the start of something major, or are things going to quiet down here now? I don't know, but there's a big problem here if things continue along the same path.
Mm. Yeah, it's always a matter of timing, though, isn't it? Because it's if you run for the exits too soon, you look like a fool. But if you start hearing real worrying signals and tremors, and you don't run at all, or you run too late, then you're wiped out.
Well, that's pretty much it here. But the question is the end of the bull market in Treasuries over? I think it is. It's possible to me that it's not. I mean, look how long the one in Japan lasted. Could the one in the United States last equally as long? Could rates drop more? Well, I don't rule that out, but I'm inclined to side with Bill Gross that the bond market, the bull market in bonds is indeed over. So do you really want to be holding them if it is? And my conclusion would be no. So, and that's what poses a problem, because it's not just new issuance. If the banks and the brokers, all start trying to dump these things, well, someone's got to own them. And the only way someone's going to own them is at higher yields. So Bernanke has a problem here, and he's actually stepping aside. Janet Yellen's going to be the next FOMC president, next president of the Fed. But so he's essentially dumping the problem on her.
Well, she happens to be even more inflation prone than he is. I mean, Bernanke was defined. She is, yeah. Bernanke was defined by his famous speech, deflation. Let's make sure it doesn't happen here. But apparently, Yellen's not happy with just stopping deflation. She seems to want to speed up inflation quite a bit. She's one of the doves.
Exactly, and it's quite possible that that's one of the things that the bond market is reacting to right now in advance. We don't know. We don't see. We don't know for sure who the next Fed chairman is going to be, but that's one of the key things. And certainly, I see little value in treasuries, even if the bull market in treasuries is not over.
Still, we're always talking about the U.S. treasuries, but if you look around Europe, European bond markets haven't just topped; they're actually starting to feel some of the pain. I mean, so far the German Bund seems to survive relatively unscathed, but the periphery bonds, as they call them, Italy, Spain, Portugal, and such like, have actually been hit quite hard. What do you think is going to happen after the German elections?
Well, all those things, all those bonds have been ticking up, and it's just all hard to say whether it's out of sympathy to what's happening here in the United States or it's its own problem. But rest assured, the banks in Europe are, because they've loaded up on so much sovereign debt, that sovereign debt allegedly has no risk to it at all, when we've already seen otherwise. We've seen otherwise in Greece. We've seen otherwise in Cyprus. I think we're going to see otherwise in Spain and Portugal soon enough. So the banks in Europe are actually in worse shape than the U.S. banks, because they are even more leveraged on government bonds than any of the banks here, in the U.S. So we've got elections coming up, and Merkel's trying to keep a lid on all of these things, on the blow up in the Italian government. There's a potential crash of the Portuguese government. The Mariano Rajoy is having his own problems, tied up in a lending scandal in Spain. All these things are happening. I think they're all going to blow at once. Whether or not this happens before or after the German election remains to be seen. We've got, a little bit more than a month to go here on that. But the other interesting aspect about European politics is the market seems and the economic pundits all seem to think that Merkel's a shoo-in, and I seem to think she's not.
She's what?
I seem to think that Merkel is not necessarily a shoo-in for German re-election. Certainly CDU-CSU is going to win the most votes, but the problem is no one's going to come up with 50%, and which means that coalitions have to be built. And all of the other political parties essentially do not like Merkel. The price for a coalition government in Germany might very well be the ouster of Merkel.
In fact, the FDP has already been paying the price, quite a heavy price electorally, for, if we're to believe the polls, for having supported Merkel so far. Yes.
And, SPD, they've come flat out and said they won't enter a coalition with Merkel. They're looking for a, what is it called? The red-green coalition here.
Yeah.
Of SPD and the Green Party. They're polling a little bit over 40%. Well, with Merkel, with CDU, CSU just polling, and FDP just polling 43%, well, it doesn't take much to swing this election from here. And the wild card to me is the AfD party. It's a Eurosceptic party.
And anti-Euro as well.
Anti-Euro, yes. Decidedly anti-Euro. And I could conceive of them getting as much as 10% of the vote, but anything over 5 makes it even harder for Merkel to form, any kind of reasonable coalition. And an obvious coalition would actually be CDU, CSU, and AfD. That's right. But on the other aspects, other than the euro. So, politics rates to be a mess here after the German elections, and I don't think that's priced in at all.
Neither do I. But also, I think the repercussions for other European countries who are depending on German bailouts will be very, very important. I mean, I think there's a lot of problems that are waiting just below the surface, as you said, in the bond markets and elsewhere in Europe, which won't rise up until after the German elections. Let's talk a bit about China, Mish, because you've mentioned several times that China might be having a bit of a slowdown, that the economic data coming out of China is worrying lately.
Well, actually, it's not worrying at all. We should be worried if China is not slowing. Actually, I think China is slowing way more than anyone thinks. There's a certain electricity usage figures that would suggest that perhaps China's not even growing at all, or maybe growing at 1 or 2%. The big problem in China is just a massive amount of public debt. And it's in the form of these state-owned enterprises that are absolutely insolvent here. And so what are they going to do about that? So the only way to fix this problem is to privatize these things, slow it down, do something about the credit, have write-offs. But all of that is going to point to, not China slowing from 10% to 8 or even 7, but all the way to 1 or 2. This is what Michael Pettis at China Financial Markets believes. This is what I believe. And so, we'll see. And the repercussions of this are pretty severe. I mean, take a look at how Australia is impacted by this. If China stops building all this roads, bridges, houses, they've got empty cities, vacant housing all over the place. So then China stops importing so much commodities. This puts pressure on commodity prices, raw material prices, the base metals, and Australia's already got a problem with its mining sector, with the China slowdown, and with its own housing bubble crash. So the emerging markets, the commodity-producing countries, are going to get hit really hard here by China's slowdown. And I don't think that's priced into the global economy either. In other words,
in fact, the problems in Brazil lately seem to stem precisely from that source.
Exactly. And I've written about Brazil. And Brazil is such a funny case because a year ago, they were complaining that the currency was too strong. Now they're complaining the currency is too weak. They're trying to prop it up. Oh, good luck with that because the market's turned. This is one of these cases, and it's going to come up again in Japan. Be careful. You get what you asked for. They wanted a weaker currency. Now they don't like it because they've got an inflation problem.
But sorry, Mish, we're talking about a weak economy in the US, huge problems in Europe, a slowdown in China. Can you explain to me how Brent is still 109 and West Texas is almost 100 again? How is oil so high with such a big global slowdown?
Well, with all the liquidity out there, and certainly central banks are trying to do that, money is going to go somewhere. Now, the Fed and the central banks want it to go into small and medium-priced lending. They want it to go into corporate hiring, but it's not. Instead, the money is going in, I believe it's going in speculation in oil. It is going in speculation, certainly in the stock market and the bond market. We're just beginning to see a revolt in the bond market now saying, wait a minute. That is, I think, one of the, explanations. We've also got some turmoil in the Mideast. But essentially, it's money looking to go somewhere, but not where central banks want it to go. And the other place money is going, ironically enough, is in capital investments, capital improvements. The price of money is so low, companies can go out there, they can expand in all of these technologies that are actually going to eliminate people. So rather than hiring people, banks can borrow it from the bond market at 1 or 2%. So they're doing that with some, buying some pretty expensive stuff to eliminate people. And so I believe the Fed's actions are actually, central bank actions in general, are actually counterproductive here.
So let's talk about gold for a minute. If we're seeing all these monetary injections, if we're seeing artificially low interest rates, how should that impact gold? What do you consider the gold fundamentals are? How would you value it?
Well, the how you value it and the gold fundamentals, you have to recall that there's over 150,000 tons of gold. All the gold that's ever been mined is still out there in existence. So I see these reports and they say, and you see it from mainstream media where, oh my gosh, mining production is up 100 tons, or central banks are buying 100 tons, or central banks are selling 100 tons or whatever. 100 tons is essentially meaningless when there's 167,000 tons of gold out there.
Yeah, let me just say it's even more exaggerated, because when Cyprus collapsed, we saw some people saying that the Cyprus's gold reserves were being in play where what was going to move the market, and there we're talking about 14 tons or some ridiculous number.
Yes, exactly. Now, oddly enough, that 14 tons is very important to Cyprus. That 14 tons might be enough to prevent, should Cyprus have left the euro, it might have been enough to prevent hyperinflation in Cyprus. So that value of that 14 tons to Cyprus was very real. But that value of that gold, its meaning to the market in general is non-existent. So people are analyzing this gold in completely wrong ways, looking at demand for jewelry and looking at 14 tons here, 100 tons there, as if it's meaningless, as if it's meaningful, when it's really not. The marginal utility for gold is whatever it happens to be at the time, and right now that's $1,200 to $1,300 an ounce. So I expect that to rise. Generally, these kinds of environments with all this money flowing is generally good for gold, but generally does not mean necessarily. And that's what we've seen here now. There's and one of the reasons I think for the weaknesses gold is what I would call a bubble belief in the Fed, that the Fed has everything under control, that the ECB has everything under control. I think we're going to see quickly enough, soon enough, that the ECB and the Fed don't have everything under control. And that's going to start the next leg up in the gold bull market. Now, precisely when that happens, I don't know, but that's how gold tends to react in these crises, although at any time it can, react just as it is.
But Mish, the reason I ask you about the fundamentals is because eventually the gold bull market will end, like it did in the 80s. And for those who, instead of looking at the price or doing technical analysis or trying to react after the fact, if you have some way of valuing gold, or at least knowing what's bullish for gold and what's bearish for gold in the macro trends, you can sort of not call the end of it, but you can see how it would end and how it wouldn't end. In the case of many people now calling the end of the gold bull and so on. So, for instance, interest rates in the 70s and 80s, we saw Volcker raise interest rates a huge amount in a very short time. Do you think if that happened now, well, if it could possibly happen now or in 5 years' time, it would end the gold bull?
Well, I think it's impossible for that to happen. If it does, it's going to cause a currency crisis, and that's not necessarily going to be bad for gold. So I don't think one can compare, this kind of market with what a rise in interest rates would do or even mean right now compared to what happened in the 70s. You had a stagflationary environment. Prices were spiraling out of control. Right now, all the hyperinflationists here have been absolutely, dead wrong. I think they're likely going to remain to be wrong. Yet that money, as I said, that the Fed and central banks are doing is likely going to go somewhere. Now, one possible way to evaluate gold is to just say, what would the price be if we took every dollar in circulation and said that it was backed up by gold? And, I've seen various targets here of between $3,000 and $10,000. It's not necessarily my prediction that gold gets that high, but that's one possible way, one could look at this. How high it actually goes or whether it could get there. But I do think that fiat currencies are going to blow up in some sort of manner that's going to be good for gold. And I would just leave it at that. I don't like putting price targets on this like other people do. And worse yet, people put price targets and time frames on it both at the same time. And that really, gets one in trouble. I just happen to look at gold here at $1,200. It was at 19. This is a normal size correction. It's not necessarily it's a decent sized correction, but gold's gone through these 40% corrections before. It doesn't look to me that the fundamentals here have changed at all. And I think gold's going to come back in play. So, my advice is to buy gold here, buy some miners here. And I did a post on that, and I mentioned all the miners that I liked. And can I be wrong? Yeah. My intention here is to not trade this and just hold it until the market sees things my way. And I'm pretty convinced that the market's going to see things this way, my way, eventually, because the fundamentals have not changed.
I agree. I want to get back in a minute to because you talked about deflation, hyperinflation. I just love that debate. But before that, I wanted to ask you about Bitcoin, because you did an interview with Roger Ver with the Bitcoin Jesus on your blog not long ago, and you've mentioned it sometimes, and still, you say you're not very convinced. You're not a convert.
No, why should I be a convert here? The free market would not settle on something conjured up out of thin air as money. Now, the reason why it's happened is because of what central banks are doing, and someone's looking for another alternative. Throughout history, the market has, where gold has been available, the market's always decided that gold was money. When gold hasn't been available, then it's been silver, or perhaps it's been copper, or in the early days of the United States, it might have been beaver pelts. But the market has, always decided on, something that just couldn't be, conjured up, out of thin air. Now, supposedly there's a limit on the number they're going to do, but were it not for government intervention forcing the dollar to be, viewed as money, I don't think we would see the rise of Bitcoin. And certainly, if gold came back into vogue here as money, Bitcoin would go away. But Bitcoin has other problems. The government can just come by at any time and say, they did it once to and just outlaw transactions in Bitcoin. Then the currency goes to being immediately worthless.
Well, Mish, let me just try to push you a bit more in Bitcoin's direction, because there's you have to see that it's not just money, it's also a payment system. It's a technology. So just the same as you can use Skype or email, even though it's, it might be replaced by something better in a while, and it's just a tool. The internet needs something that can act like cash, and you can't do that with beaver pelts or even with gold at the moment.
Well, I mean, you can certainly do it with U.S. dollars. You can do it with euros. You can do it with yen.
Well, not really, because if you want to accept donations on your blog or subscriptions on your blog, you would have to go through some kind of payment system to accept euros or dollars. You would have to go through a credit card or PayPal or some kind of payment system. And say you have a subscriber from Somalia or from, from South America. They might not have access to a credit card or to the general Western banking system. And that's where Bitcoin steps in.
Well, but how do you get Bitcoins? You got to buy them. You've got to conduct a monetary transaction. You got to get that. You got to get the money to convert, into Bitcoins in the first place. So,
well, you can earn them. There's quite a market right now for labor paid in Bitcoins.
Well, okay.
I know. You'll never be convinced, but I earnestly encourage you to at least experiment it. Try to accept donations on your blog in Bitcoins. See what the result is. It takes about 30 seconds.
I've got a free policy on my blog. Everything I write is free. So unlike a lot of other bloggers, I don't have a tip jar out there, but and I have no plans to put one out there. But I do have my first Bitcoin. Following the interview with Bitcoin Jesus, he sent me a Bitcoin. Not precisely sure here what that thing is worth now, but I have one.
Let's talk about Japan, because I feel it's the most extreme case with Shinzo Abe promising inflation at all costs and bringing out the cheerleaders for people to try and buy all things Japanese. The government has to tell them to buy stocks and so on. What do you think is going to happen there?
I think Japan is headed for a currency crisis, probably the first country to have one. And they have this idea that they can generate 2 or 3% inflation and hold the interest rates in Japan on government bonds at 0.5%. You think that's possible? I don't. And there's all kinds of repercussions to it. first off, if they succeed in trashing their currency, which I think they're going to do, it's going to exasperate their problems on all their imports. And since Japan produces virtually none of its own oil and gas, it's going to exasperate their trade problem. So then, the second thing is that because the balance of trade is going to be impacted, they're going to need to raise money, and Japan has recognized that. Abe wants to hike taxes in Japan by a massive amount, and what is that going to do to their economy?
Right, so it's like the trifecta. It's going to absolutely destroy them, right? High inflation, crashing currency, crashing bond markets, and high taxes,
and a balance of trade problem. So yes, I mean, well, in theory, Japanese are going to be, exporting more. Okay, so they export more cars, but what about all the oil they import? What about all the food they import? What about everything else? So I think they're quickly going to find out, as did Brazil, that once they achieve this thing called inflation, and once they achieve this thing like devaluing their currency, they're going to see that it's not the good thing that they think it is. And the problem then with Japanese government debt at 240% of GDP, it's going to cause far more repercussions than they believe. So Japan is heading for a currency crisis, and the trade to take advantage of that actually is to be long Japanese equities, but hedged for a collapse in the price of the yen. That's a trade that I am in.
Nice. Although the timing will be complicated, but it does look like time is running out, isn't it?
Again, I don't want to put a time frame on this, but Japan is in trouble, and I don't think we're talking about a 5-year time frame anymore. We're talking about months to a couple of years, maybe.
We're almost running out of time, but I'd like to ask you again about deflation versus inflation, or versus hyperinflation. You've been one of the few Austrians or Austrian school sympathizers who has bet for the past few years on a deflationary scenario instead of an inflationary one. And you seem to have been right, or at least those who are betting on high inflation straight away have been wrong.
Absolutely, they've been wrong. And they don't understand credit. I don't think they understand, what's going on here in the job market. I don't think they understand the impact of the housing bust and all that debt that's out there, and just the amount of debt that's out there that's just acting as an overall drag on the economy. Most of these guys, just looked at what central banks were doing and saying, my gosh, this is going to cause hyperinflation. I looked at it and said, no, it's not. And certainly I would say that, I've been on the right side of that. There's a lot of people out there that think that inflation's way understated. And certainly if you look at education, if you look at healthcare, that would be the case. But it's not the case if you look at food, which I think is reasonably steady. And it's not the case looking at technology. It's not the case looking at wages. It's not the case looking at a whole bunch of other things. So this doesn't mean that Bernanke's done a good job. Far from it. This just means that we've not paid the price for it yet. So I'm an Austrian economist. Well, I'm not an economist, but I'm in that school of thinking. And to me, the simplest way to describe it is that the free market knows best. It would set the correct supply of money. It would set the correct interest rates. It would would get the government out of the way, and businesses would know better how to spend their capital and on what, rather than the government trying to micromanage things. Certainly, if you look at the history of the Fed and central banks in general, they've blown one bubble after another after another. The free market's never been tried. And all Austrians are saying is, give it a try. And certainly that's the school, that I'm in. And the alternative is micromanagement by central banks that has never been proven ever in history to work.
Central planning. What a great, wonderful
That's
idea.
What it amounts to. It's very tantamount to the days of central planning in Russia, where Russia had its target on how much steel should be produced, how much cars should be produced, how much everything should be produced. Well, when you produce too much, the price crashes. When you don't produce enough, prices soar, and the government could never get its production right and could never, pay enough. So there were always shortages of things and there always will be shortage of things and mispricings of things, surpluses of things. If the government pays too much for an item, you'll have overproduction of those items. So the only thing that makes any sense is for the government to get out of the way, let the free market work. And people don't even understand. This is the sad thing, the free market. I think the free market caused this housing crash. No, it was government interference, pushing houses, pushing the home ownership society.
But Mish, there's people who claim to be very pro free market, but they think that there's some kind of exception for the price of money and for the production of money, that it's not like steel or shoes or any other product, and that government really does know best there.
That is it. They don't understand. They think that somehow money is different. Well, actually, money is a commodity whose main purpose is serves as a role in trade and a pricing mechanism. But if you think of money as a commodity, and so why should the government or the Fed or any individual know what the supply of any commodity should be other than any other commodity? And I don't think they do, and they've proven it.
Well, I thank you very much, Mish. We're going to have to end it here. It was great talking to you. We'll love to have you back. And, we'll be very interested to see what happens in the next few months, given the warnings you've given. This was Mish Shedlock from Global Economic Analysis. Thank you very much, Mike.
Pleasure to be on the show. People can find me by doing a Google search for Mish, reading my blog.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.